Hey everyone, my name's Andy. My channel's Finding Value. If you're a new subscriber, welcome. If you're a subscriber, leave comments below on what you guys want to see, what you want to hear. Actually, in this one, I'm actually responding to a comment. I call it Uranium Gains. So we'll pop in here and talk about uranium gains. So the question is, what is the best way to invest in the upcoming uranium bull market for maximum gain? Explorer, producer companies. Also, do you use the ratios only to better understand the value? It's a good question. So I'm going to jump right into using the ratios, market conditions, and then answer the best way to play this, in my opinion. We use ratios as a guide to let us know if something is undervalued or overvalued and how much it is so in relationship to history. That is what ratios tell us. It's relative value in relationship to history. We use this as our indicator of value. We use market conditions in real estate to see when conditions for the markets change for our investments. So using value and market conditions lets us know when to hold or when to throttle back our investments. What you're going to see is if real estate prices start having trouble and you see an overvaluation on the ratios in the commodities, so think of uranium to gold ratio and the S&P 500 to commodity ratio, that is when you're going to have to sell to get out. So it's real estate prices, those indicators, so that's days on the market, inventory, foreclosures, when those all start getting, we'll say it kind of bad, and it's reversed for, let's say, a year, you're going to eventually see house prices go down and housing starts go down. That is what's going to be holding all of this in a inflationary, that's what the inflation, that's the wind at our back. Then the valuation, if that's overvalued and you see real estate having trouble, that's when I'm going to sell out. So ratios tells us our valuation. Current market conditions. So current conditions show that the overall commodity index is cheap to stocks. The current ratio shows that gold is also cheap to stocks. The ratio of uranium is cheap to gold. And the technical analysis shows that major chart patterns being broken to the upside. So what I say, whenever you have this alignment above, it's on like Donkey Kong is what this means. Watch your gauges to see market conditions, and your gauges are the real estate indicators. It's also your ratios to see when things get cheap or when they get expensive. Long-term investments given fundamental analysis, and that's looking forward at the market balance forecasts. Uranium has a lot of deficits years out, and it's a growing deficit. So the conditions, overall market conditions for uranium have never been this good because, one, the valuation is absolutely dirt cheap for uranium in relationship to any other metric, in relationship to gold, in relationship to stocks. You've got technical analysis saying that the major chart patterns are broken to the upside. There's your timing. And then you look at the fundamental analysis of market balance in the future. And that says we've got growing deficits in the future for uranium, given current supply forecasts. So it's all like Donkey Kong. That's what I say. So how do you get the maximum gain out of this? How do you get the gains out of this uranium play? What I'm going to say is, mining companies provide value to shareholders in two ways. This is important to understand. You can gain value through exploration, and you can gain value through producing that commodity and selling it to the market. Those are the two ways. If you can find a company that has both exploration and production, these typically give you the most returns. Look for experienced management teams who've done it before. They know what they're doing, they've done it before, they know the hurdles to jump over when they come. Now also, this is a must include in your portfolio. You must be investments that will for surely track the uranium price. We know this is a big opportunity, and I wouldn't speculate everything on potential outcomes. You don't have to go on super high risk here. You need money in as for sure of bets as you can get. So getting some money into an overall index, I think is pretty smart. Because the overall index, this will for surely capture the move. Perhaps this is where you put the bulk, the big bulk of your money. You can't go 100% into high risk speculative things, because if they don't pan out, you're going to miss your opportunity for this gigantic move in the uranium market over the next 5, 10, 15 years. So you have to make sure some of your money is in the for sure move. If uranium's going up, you got to have something that's highly correlated to uranium. An explorer may not have that correlation that you want. That's all I'm trying to get at. And speculative stocks, spread the money out amongst 4 or 5 of your favorite picks. Some could absolutely explode higher, and you want to make sure that you capture those ones that are going to go berserk. And maybe perhaps take different strategies when selecting your stocks. Some of them might be Africa plays, some might be Canadian miners. Perhaps some are in different stages of exploration and production. And perhaps some are not really the favorites of the uranium community. Be a contrarian amongst the contrarians, so to speak. So the conclusion here is this could potentially be some of the biggest opportunities of your investing life because of the valuations being so cheap and the potential deficits, fundamental deficits of uranium out there 10, 15 years out. Watch your indicators like they are your temperature and pressure signals for a race car. That's my analogy. I'm going to step back. I skipped that one. Take advantage of it and put in the work now so you don't sell out. Make sure you know exactly what companies you have. Make sure you've got everything dialed in and that you know what the CEO's name, what he does or she does. Make sure you know as much as you can about the company so you don't sell out midway. You want to ride this valuation from cheap all the way to expensive. And again, I'm going to go back. Watch your indicators like they are temperature and pressure signals for your race car. So you're going wide open throttle with your investments. When your valuations are cheap, when the conditions are good, it's wide open throttle. You're adding money, you're cost averaging in, it's game on. On like Donkey Kong. Watch the indicators for changes, but this should be years out. So your indicators are your temperature and pressure on a race car. You're making sure your temp's good. You're making sure your oil pressure's good. You're making sure all these things are good as you're wide opening throttle and racing the car. We're racing in these vehicles. We're using these, it could be higher risk companies, and they're going up 10, 15, 20, 30% in a day, just ridiculous amounts. And you're going, should I sell? Should I sell? I'm up 100%. I'm up 200%. Your indicators, your temperature and pressure sensors are real estate and housing starts. Is real estate going higher? Is housing starts going up? Because if that's true, you don't need to throttle back. And if your valuations on your ratios are cheap, that's your other indicator. It's saying ratios are cheap. We're good to go. Real estate's continuing to go higher. We're good to go. Inflation's at our back. We've got the tailwind. The dollar's going down. The 10-year is going up. Those are all things that are tailwinds and indicators to stay in the throttle. So again, spread the money out. Have some for sure captures of value in your investment portfolio. So don't put all of it in the speculative explorers. Make sure that you have some investments that are for surely going to capture this move. They are producers. They have, maybe it's a mining index. Do not go 100% in explorers, and I don't think you're going to get what you want, but have some in there, because if they explode, they become an explorer and then a producer. You could get some very, very good gains. So spread it out. That's what I'm doing. I'm finding my favorites, my 5 or 6. I spread them out amongst my favorites. And then it's just hold on and watch those indicators. Watch the ratio. That's why I go over the ratio once a week or so. Watch real estate. Watch the leading indicators of real estate. Watch housing starts. Watch all that stuff and learn about it. because those are your gauges. They're your indicators. They're telling you if something's going wrong before something goes wrong. So obviously we're in this together. We're riding this thing. We're riding it up. We're riding it down. We're riding it all over the place. If this ratio's cheap, I'm going to continue to add whatever money I have into these companies. And when it starts getting more fairly valued and more expensive, I'm going to look for better opportunities down the road. That's not right now. That's down the road. So if you guys enjoy this content, click the thumbs up, help me out. Oh, there we go. And subscribe if you haven't. So thank you for listening. This is Finding Value.